And 3, 2, 1.
Here we go.
Hey, everybody notice I didn't play the music as loud this time. Because I've had a few people saying, man, it's blaring. And I don't hear, we don't hear it quite as loud as you guys do sometimes. So I just tuned it down a little bit. We're taking
the
guys,
constructive feedback.
Absolutely.
Yeah.
And by the way, I can't make this thing straight. I can't, there's no more nails would
Can't
go
put
in
a
this.
nail in the wall.
Yeah, and it just, oh, see?
Yeah, there you go.
Story of my life. It's a little tipsy, just like we are. Dun-dun-bum. No, we're not tipsy.
Not right now, anyway.
It's freaking Friday morning.
Friday morning?
Yeah.
Dude.
What do you got for us this week? Give us something juicy.
Another big week, right?
Yeah.
We're going to talk about it a little bit, but you got CPI and the Fed meeting on the same day. You never get that. And you know that the Fed had the CPI data that came out that morning. They had it before they came out, with the announcement in the afternoon. And so I'm kind of surprised it was the CPI came in less than expected, which is bad for the economy, good for the market. But then when the Fed announcement came out, it was very hawkish. It was much more like we're going to keep rates higher for longer. So because what they call the dot plot is all the 19 Fed governors and presidents and whatever. A lot of them didn't want, they reduced the expected number of rate cuts, which is hawkish, which means they're going to keep rates higher for longer. So we have a big gap up in the morning, and then it kind of reversed and closed at the bottom of the trading range for the day. And then PPI, Producer Price Index, comes out the next day, and that's also, that was pretty significantly less than what they expected. So the economy is rolling over. How that translates into the stock market is that the Fed's going to cut rates, and so the market's going to go up because the Fed's cutting rates. It's teetering on this crazy verge of things, and that if I think this is going to be a pretty good podcast. I got a lot of good stuff in here. If there's any takeaways, now is not the time to be complacent. That's really, I mean, I'm not saying the sky's falling. I was watching Invest with Jacob is the YouTube channel. It's pretty high level technical analysis, so people probably may or may not like it, but it's West Point guy, and he does he does Elliott wave analysis, and he's been generally bullish, right? But he looks at 1 hour charts, so they're much smaller time frame than what we look at. But he's like, he keeps calling for a tick here higher. We're not quite at the top yet. He's doing the Elliott wave counts. We're not quite at the top yet, and he's looking for price to go a little bit higher. But in the big scheme of things, he's like, oh no, we're coming to a top, and I think it's going to be a major top. So now is not the time to just go, Apple's way up and everything's great, and
don't go on vacation.
Don't if you're going to go on vacation,
put your money in
put
cash.
your money somewhere else, and we're going to talk about where that else might be too. All right. So I kind of already covered this, but economic data for the week, we'll go through it a little bit. And then the other thing, bonds, the F fund and the G fund. People, I don't think, understand. Bonds are a little bit complicated, and I'm just going to do a little quick, what is a bond, what is the F fund, and what is the G fund? Because basically, TSP, we have people think there's the stock funds and the F fund is the bond fund, and the G fund is essentially a bond fund too, but they work in different ways because the F fund is at bond price, and the G fund goes up and down based on bond yield, which is the opposite of price. So there's sometimes that you want to be in the F fund, and sometimes you want to be in the G fund. They're not the same in terms of bonds, right? And the bonus chart, I could have done a bunch of different ones. I looked at doing Apple because Apple just exploded to the upside this week out of almost a year-long sideways consolidation pattern. But this divergence chart is way too important not to put up, so I'm going to do that, and then the TSP charts. All right, so this week we have CPI, Consumer Price Index, on the same day as the Fed announcement, and that was on Wednesday. And then Thursday we got Producer Price Index. So CPI is a measure of inflation, right? Inflation slows in May, with consumer prices up 3.3% from a year ago. So this is something we always see in the Facebook group, right? Inflation, when they measure inflation, they do month to month, but the year over year is what that 3.3% is. And what that means is from a year ago, inflation is up 3.3%. If it ticks down to 3.2% next year, let's say, that just means that inflation went up. Things cost more by 3.2 instead of 3.3. They still cost more. The grocery store prices are not coming down. Inflation, like the only time you get a reduction in price is called deflation, right? So you can have a reduction, you can have disinflation, they call it, which just means the rate of inflation is slowing down. It doesn't mean that prices are coming down. They're still going up. They're just not going up as fast. Okay, but if they're not going up as fast, it means that the economy is starting to weaken, and it gives the Fed a chance to cut rates. So the Fed's supposed target is 2%. So when inflation gets down to 2%, that's what the Fed is trying to do. And they raise rates to try to push inflation down. And they're not, on a percentage basis, the difference between 3 and 2 is 50%-ish. I can't do the math in my head, but it's a long way on a percentage basis from 3 to 2. And we've been flat, at above 3 for quite a while. So there's all this talk about rate cuts, but theoretically, the only way you get inflation to come down to 2 is to have rate hikes. Okay, so if the Fed continues to raise rates or leaves them higher for longer, leaves them where they are, and inflation starts coming down because the economy is weakening, and rates stay the same and we get down to that 2% inflation level, then great. Maybe then the Fed can cut rates. But somewhere between here and here, while the economy is weakening, it's likely to collapse because rates are being kept higher for longer. So that's like the tightrope that the Fed's playing right now. And they were hoping to get inflation down to 2% without the economy collapsing. And that's the big question. Can that happen? So then the Fed comes out on Wednesday, and they changed their projection to 1 rate cut from 3 for this year, the rest of this year. The dot plot. So that's kind of something that it's a little bit of a high level technical stuff within the Fed, but it indicates how the 19 FOMC members vote, because there's the Fed chairman who comes out and does the announcement, and he's basically summarizing what all of these 19 people on the board are talking about, and they all get a vote. And so their votes all come out on this thing called the dot plot, and what they basically voted for was 4 of them wanted no rate cuts this year. 7 wanted 1 rate cut, and the other 8 wanted 2 cuts. So the average of all that now is 1 rate cut by the end of the year. And all that means is a 0.25% rate cut. It's not going to change anything materially in terms of interest rates. Credit card rates are still going to be high. Mortgage rates are ridiculous, and they might level off and maybe come down a little bit, but probably not. I mean, a 1 rate cut doesn't do anything. And then we get PPI, which did fall more than expected. That was a bigger number than what they thought. So inflation is coming down, and whether or not they keep saying that they're going to be data dependent. So we'll have to see what happens. It'll be interesting. I seriously doubt there would be a rate cut in September unless the economy, the market seriously rolls over. There's another guy I watch on YouTube. He was like, Fed's not cutting until that the market is down at least 10%. If the market starts caving, then the Fed, probably actually cuts rates, which means then they're trying to catch up with the market falling, which is exactly what is the worry. And so how do we manage that in TSP is what we're going to kind of get to. So bonds, the F fund and the G fund. So if you don't understand how bonds work, take a look at that Investopedia article. It's pretty simple. a bond is it's a loan to a government or a company, right? And they call it fixed income because you're getting an interest rate for the money that you lend to the government or to a company. So bonds are used by companies, municipalities, whatever, to finance things, right? So owners of a bond, which is you, if you're buying a bond, you're the debt holder or the creditor of the issuer, which is the company or the government entity. So a bond is referred to as fixed income since bonds traditionally pay a fixed interest rate, which they call a coupon, right? This is the biggest one that confuses people. Bond prices are inversely correlated to interest rates. So when rates go up, the price of the bond goes down and vice versa, okay? Bonds have a maturity date at which point the principal must be paid back in full. So you buy a bond for $1,000. You're loaning $1,000 to the government. Let's say you buy a treasury bond. If the interest rate is 5%, you're going to get a 5. So if you $1,000, what is that? $50, 5% on. So you're going to get $50 over the course of the year, and then at the end of, say it's a 10-year bond, at the end of 10 years you get your $1,000 back. If you can hold that bond for the 10 years to maturity, and you can get $50 a year guaranteed every year, and then you get your $1,000 back at the end. If you want to sell that bond, you can sell it to somebody else, but if the interest rate has gone up, then the value of the bond has gone down.
Right. So you're going to get your principal back because you get that part back.
Well, if you sell the bond, I'm saying if you ride it out, you're going to get your principal back. If you want to sell that bond, so not take it to expiration, but you want to sell it to somebody else. So it's a 10-year bond, you've had it for say 2 years,
yeah,
and you want to sell it to somebody else. If you had bought it when the rate was 5% and it goes up to 6%, the price of the bond is going to be less. Because
its original price was $1,000.
Yeah. So now it maybe you might only be able to sell it for $900.
That's what I meant when I said principal back. So the normal reason for doing that, right? Just to put this in some context, right? So, why would I sell the bond? Well, maybe you need to liquidate it, right? You need cash.
Yep.
You need the cash for something. So now you need to sell your bond. The upside or downside could be to that you don't get your full $1,000 back. Now you might, if the reverse of what Jerry's talking about,
if rates go down,
right, the bond might be worth more,
right,
and not only so now you're getting a little bit more than your principal back. You're not going to get the yield each year, right?
Yeah, because the
person that buys it's going to get that.
Right.
So it's balancing all these numbers to kind of figure out what's in your best interest, right? Some people will sell a bond because they went up and they think they're going to come back down. So they're like, okay, I'm going to take advantage of this and I'm going to sell the bond and walk away. But generally speaking, people buy bonds to hold so that they get guaranteed interest back. That's why they call it fixed income, right? So people that are in a situation where I don't really want to deal with the volatility of the market, of the stock market, I'm going to buy a bond with my large amount of money, knowing that I'm going to get a certain percentage.
Right. Yeah. If you have $1 million on the side, and you're like, I don't want to mess with the stock market, and treasuries are at 5%, let's say right now, you can buy a 10-year treasury bond with your $1 million, and you're going to get $50,000 a year. So if you can live on that $50,000, it's a dividend, it's a yield. You're going to get that every year.
Passive income, fixed income,
right?
Yeah.
For 10 years. And at the end of 10 years, you're getting your $1 million back.
And it's as guaranteed as possible.
Right. So that's the other thing, right? If you buy a treasury bond, that's about as guaranteed as possible, right? And I'd say that's 5%. If you buy an Apple bond, that's pretty guaranteed too, right? Apple is probably one of the too big to fail, probably not going anywhere, but it's a little bit more risky than a treasury bond. So you should get, if the treasury rate is 5%, an Apple bond, you need more.
Should be a little bit more.
Should be a little bit higher, right? So maybe it's 6 or 7%. And if you're willing to take the risk, which there is some risk that Apple could have problems, if you're willing to take that risk, then you go with that Apple bond. If you're going to hold it to maturity, it's fine, because unless the company dissolves, which is very unlikely, you're getting your 6 or 7% instead of 5%, and you hold it to maturity, and you're still getting your $1 million back. So yeah, that's basically how bonds work. Okay, the F fund. The F fund is it's the aggregate bond fund. Okay, that's what the F fund tracks, the aggregate bond fund. And within the aggregate bond fund is mostly U.S. Treasuries, so very safe. Fannie Mae, which let's just say they're government agencies, so they're relatively safe. You can argue whether or not mortgage-backed securities are a safe investment, but it's a government entity. So Fannie Mae, Freddie Mac, and a couple of other government entities. So the vast majority of the weighting is in government-owned instruments. There's also a small weighting in some corporate, right? So Bank of America, J.P. Morgan, Morgan Stanley. But the vast majority of the F fund is in relatively safe government securities, right? So it's a combination of all these things. And in the F fund, you're talking about price, okay? So it's not yield we're talking about price. So this is a chart of the F fund going back to the beginning of when the AGG started, okay? So, it's generally gone up over time as interest rates have fallen. And then once the Fed started raising rates and all the interest rates across the yield spectrum went up, yield went up, the price of the F fund went down, okay? So now we're at this, we've had this 1, 2, 3, 4, 5 wave pattern in the price of the F fund. And then we had a 1, 2 going the other way, right? So if you want, what you ideally want to do is be in the funds that are undervalued when they start going the other direction. If you're going to reallocate from the C fund, let's say, to some other fund, you want to do it, you want to reallocate to a fund that's likely to go up, and you want to get in on a defined risk place. So we've had this long decline in the price of bonds and the price of the F fund. This is going back, so this was the top in price in 2020, okay? And we had this 1, 2, 3, 4, 5 decline in price, right? And now we have this 1, 2, okay? This is a weekly chart, right? We just broke out this week on a weekly basis from this downsloping trend line. So if you are interested in being in the F fund, it's a really low risk place to enter, because if it's wrong, if it does roll over, right, you would look at it, if you bought the F fund here, you would sell it if it got below that support level. So your risk is this much, okay? But the potential upside is at least, right, this is an ABC. If it only goes that high, that's your first upside target. So your risk is this, your minimum upside is that, and your potential upside is back to up here. So right now, the F fund, it's a super low risk entry, because this is where you would get out if it's wrong. So your risk is very low, okay? That's kind of a foot stomp. That's as good as I'm going to get. Okay, so that's how you would look at the F fund. The G fund, right? This is a pretty good article if you want to kind of do a deeper dive into what the G fund is about. But right now it's at 4.75. And the way you would find out is you just Google what the interest rate on a TSP loan is, and whatever that rate is, that's what the G fund rate is right now. So right now it's roughly 4.75%. That kind of corresponds to the 10-year yield. So when yield goes up, right, the G fund is all about yield. It's not price. So when yield goes up, the price of the value, the rate of return of the G fund goes up. When yield goes down, the rate of return on the G fund is going down. So how do you make sense of that in terms of a chart? This is the 10-year treasury yield, okay? So the G fund, or it's not exact to the G fund, but it's a way to chart it, because there is no chart of the G fund. So this is as good a way to chart it as you're going to get. So the G fund bottomed out down here in 2020 at about 0.5%. And then rates have gone up over the past few years. They peaked at about 5%, and right now, like it said on the slide, it's whatever, the G fund is roughly 4.75. So the G fund rate is somewhere up here. If you're looking at it on a chart, the 10-year yield came up in a 1, 2, 3, 4, 5. Peaked at 5%. It's coming down in this A, B, C, right? So rates are coming down, right? And they just broke through. This is a weekly chart of the 10-year treasury, right? So this is a pretty strong trend line right there. And this week we had a breakdown in rates. So rates are coming down, which means the value, the rate of return on the G fund is decreasing. Okay? So at the same time the rate of return on the G fund is decreasing, the rate of the price of the F fund is breaking out to the upside. So if you are price of the F fund is breaking out to the upside, and you have a low risk place to buy it. So if you are looking at reallocating out of the stock funds because you think the stock funds are overvalued, and you're trying to decide, do I want to go into the F fund or the G fund? The F fund is moving higher, the G fund is moving lower. Okay? All right. Okay. So that's basically bonds and the F fund and the G fund, and how you try to decide, given the market conditions, which one you want to be in. All right. So we basically talked about where you want to go if you're worried about the stock funds, right? So here are the stock funds compared to each other. You got a weekly chart. The S&P 500 is in black, so that's the C fund. The S fund is in orange, and the I fund is in blue. Okay? So it's a weekly chart. So if we go back to what happened when the market rolled over at the end of 2021, beginning of 2022. So the reason I put these boxes in here is because the funds generally go up and down together, right? They don't go down. They don't go up and down on the same percentage basis. But if you overlay the charts on top of each other, they move up and down generally together. So everything starts falling here at the same time from COVID. They all turn up together, right? They're all going up and down together. When they diverge is when something is going on. So at the top, at the end of 2021, you got the S and the I fund moving lower as the C fund is still moving higher. Okay, it's a big divergence there. So you get the S and I funds rolling over, and the C fund's still moving higher. Then they all start going down together, right? And then over the past year or so, they all start turning up together, and they're basically moving in tandem until a few weeks ago. You get the I fund tanking, the S fund lower highs and tanking as the C fund keeps moving higher. Okay? The implication is that the C fund is going to roll over along with the S and the I funds. How much it rolls over? Do we get something, are we looking at this kind of thing where we get a big pullback in all of them? Impossible to know. But something is going on here that's worth looking at. It's not that it's worth looking at. We are looking at it. It's worth keeping in mind because, like I said, now is not the time to get complacent. The stock funds are overvalued at the same time that the F fund is breaking out to the upside.
Right. Yeah, these are the things that you want to keep your eye out for when they happen, right? So all that time, Jerry's showing that, the chart there, and we're all just happy, and the C fund's going up, and pretty much all three of them are going up, and everybody's happy, and something like this happens. If you're not paying attention, you don't see this happen.
Right.
You're not watching a show like ours or following somebody else that's tracking this stuff. You're going to miss the boat. You're going to be it's going to be sore. It's going to hurt.
Most people, by the time the market rolls over, are going to scramble to see where to go, and by then the F fund is going to be overvalued, and the only place will be the G fund, and that's decreasing because rates are coming down.
Right. And this is where you want to start to look for your next move. Right. So you start making your plan, build your plan. Okay, this is what I see happening. Because right now what you've got is not enough to make a decision, right? So we're just looking at the chart.
Yep.
What you have is an indicator that says I need to go ahead and find out what my next move might be, and that's going to be a plan A and a plan B, right? There's never just one.
Right.
You need to have both. That's something people miss sometimes. They're like, okay, well, if that happens, I'm going to do this then. Okay, what happens if it doesn't happen?
Right.
What are you going to do then? You have to have both of those figured out, because generally there's not enough time after, like you said, you're just scrambling, and then you're making emotional decisions. You're not making fact-based, data-based decisions.
I mean, if you're fortunate
Data-driven.
enough, right, data-driven. If you're fortunate enough now to only be in the C fund, right, you're still, the C fund's still going up. The I fund this week particularly got clobbered. The S fund has already put in lower highs and is still going down. So if you're fortunate enough to only be in the C fund, that's the decision. It's not whether or not do I want to go to the S and the I fund, because obviously they're rolling over. You want to go to a fund that is undervalued and turning up.
Right. So
which is the F fund.
Right. But your choices where you start with is F or G, right? So when we always talk about being in the stock funds when the market's going up and being in something else when it's going down, right? That's pretty simple.
Yep.
But you do have to remember that you have two options. And most people don't even think about the F fund.
Right.
Why? Because generally speaking, it's not always. There's long periods of time when it's not valuable to use until it is.
Right.
And you can squeeze out a little bit more return for a period of time.
Yep.
In the F fund, and then go to the G fund if everything is turning over, which, historically they didn't, right? If stocks were going down, bonds were going up, so it was a great place to go hang out. Doesn't necessarily work like that anymore, but you still have that G fund choice. And the good thing is if the F fund's going down, the G fund's going up.
Right.
So it's a better place to be. Two of the most underused, undervalued choices in your TSP account, the F fund and the G fund. And so many people will try to argue with us, or they won't even argue. They'll just blow it off. They'll scoff and go, you're crazy. And we're like, how is that crazy? Do you want to stay in a fund, in an allocation that's losing money, right?
Yep.
Your account balance is going down. This is how it works. If your account balance is draining, you're losing money.
Yeah.
So would you rather go somewhere where it doesn't drain, or maybe drain slower? Whatever your options are. Yeah. So
I see it all the time on Facebook. I responded to a guy earlier today or yesterday. He says, I'm a young adult, and what should I'm predisposed to buy and hold. So is there really value in trying to actively manage your account? And a lot of people would say, if you're young, you can ride the ups and downs, and you can. That's fine. But I don't care if I'm retired. If you're retired, you don't want to take big hits in big drawdowns. But if you're young, like this is what I told him. I mean, if you had $1 million in 2000, by 2003, that million was cut to 500,000, and then it came back up by 2007 to even basically, and then rolled over, and you were down again 55% by 2009, and it took until 2013 to get back to even. So 14 years from 2000, from that top, it took 14 years to get back to even. That's half your career. It's astounding to me that people don't look at it that way. Anyway, so yeah, if I'm definitely paying attention right now. If I'm a TSP investor, to look at it and say, okay, I've made some decent gains over the past year or whatever, that's one thing. That's fine. If we're approaching a major top, I want to see that top confirm, but I don't want to be holding on. I don't want to be holding the bag, you know? All right. TSP fund charts real quick. If you're looking at the C fund, everything looks groovy, right? It's a weekly chart. We're at new all-time highs. We're pretty well above that 20-week moving average line. Everything looks great. If you're the S fund, you know, a lot of really smart people think that the S fund has room to move much higher from here. I can understand the argument, but we have lower highs right now, and as of whatever time, you know, it's Friday morning. So if we close here, we had a pretty serious reversal, and we're below that 20-week moving average line. The S fund has a lot of work to do. It's got to get back above this high before it's worth. Right now, the trend is down. If we get below this low, right, you got a lower low and a lower high. The trend is down. So right now, it's kind of going sideways, but it's definitely not sort of an optimistic chart. The I fund got crushed this week, and we talked about it last week. I can't remember if it was the podcast or the newsletter, but I fund put in a triple top back here in 2021, and then rolled over. You know, had that big decline in 2022, came back up, and for 1, 2, 3, 4 weeks was banging against that prior resistance level, right? And then completely got rejected this week. So the I fund is not looking good. Can it recover and eventually bang up against that resistance and then break through it and keep moving higher? Yes, absolutely possible. If the I fund gets below this low, it's going down. And then the F fund we talked about. I don't know what else I can say about the F fund, but that is a monster candle to the upside when everything else is showing that it's topping. So take it for what it's worth. Obviously, for the subscribers to the site, we do a whole lot more in-depth, and it's more day-to-day analysis. And so if you like what we're doing on the podcast, definitely sign up at growmytsp.com.
Yeah, if you like it, share it with your friends.
Yep.
Please put it in the comment section if you have some thoughts on what we've shared, if you're good or bad. We like to get feedback.
Yep,
and
absolutely.
a lot of times we end up using stuff for the show, so it's great. I hope you guys are having a great weekend. I did forget to say at the beginning of the podcast, happy birthday, Army. It's 249 years, the birthday.
All right. Yep.
Friday
Birthday
when we're recording this. Sunday is when it comes out.
Excellent.
But yeah, if you're in the Army, happy birthday.
Very good. Very good.
See you guys. Hope you have a great rest of the weekend and a great week.
Out of here.